Hi there, I'm Sup Day. I'm a chartered accountant and I'm hoping to do some tutorials in financial accounting and reporting, and this might help students who are sitting for accounting examinations. Understanding financial statements involve making sense of the numbers that appear in an entity's financial statements. This is done by interpreting the KPIs in the financial statements. There are three main financial statements involved: the income statement, the statement of financial position, and the cash flow statement. In the first tutorial, I will focus on the income statements. Another name for the income statement is the profit and loss account. The profit or loss is the difference between revenue and expenses. We will use a listed company. In a listed company, the shares are traded in a stock exchange to identify and explain the KPIs used to examine the data in financial statements. Well, we're going to start off with a company called Superdry Group PLC. The word PLC stands for Public Limited Company. The ordinary shares of companies with the prefix PLC can be bought and sold in the London Stock Exchange. Now, to interpret or to identify or perhaps understand the data in the financial statements, it is important that we understand what that company's business model is or how it makes money. And this is what Superdry says. We design, produce, and sell premium branded apparel to a global marketplace, adopting a flexible, capital-light, multi-channel approach to markets means we are able to evolve quickly to maximize opportunity. The word capital-light here means that it outsources the manufacture of apparel to third parties. Multi-channel approach means they sell on physical shops, they sell online and through social media, franchises, and wholesalers. Finally, Superdry is a global company as it operates in 61 countries, in 241 stores and 44 international websites. We'll have a quick introduction to the key performance indicators for financial statements. Sometimes they're called business performance indicators. The KPIs are used to monitor an entity's progress towards its strategic goals. These KPIs can be financial or non-financial indicators. The focus on this tutorial is on financial KPIs shown in the chart attached. The basic type of financial KPIs are highlighted in blue in the chart shown. Profitability ratios, and again the word profit has various levels, example gross profit, operating profit, net profit. Cash flow measures, and again this is important because profit and cash are not the same. For example, a company can be profitable but have a negative cash balance. Liquidity ratios, solvency or debt level ratios, efficiency ratios, and capital market ratios. Right, we'll have a quick summary of KPIs before we move on. The key features are: 1, they are viewed as the key to a firm's success. It is quantifiable, and they are used to benchmark current year's performance against previous years or competitors. Superdry plc is a company listed on the London Stock Exchange. The financial statements for listed companies will show the result for the current year, which is 2020, and the prior year, which is 2019. Superdry plc is a group of companies. Its financial statements are the results of all the companies in the group presented as one single entity. They have been consolidated and presented as one financial statement. The financial statements also indicate that all these companies, subsidiaries, are 100% controlled by the parent company, as all the profit/loss belong to the shareholders of the parent company. For example, in 2020, the loss for the period was 143.4 million, and all of it is attributable to the owners. The other thing that we need to look at, or perhaps understand, is that comes under other comprehensive expense. For example, in 2020, it was 2.5 million. These include unrealized gains or losses, and as such excluded from the profit and loss for the current year, which, as you've seen again, is 143.4 million. Right, what we'll look at now is what Superdry considers its key performance indicators. And these are, some of them would be found in the financial statements, and some of them would be found elsewhere. The first one is group revenue, which is then, if you like, segmented elsewhere into retail revenue, wholesale revenue, and e-commerce revenue. The next indicator is the group gross margins. Again, the actual percentage is not shown, but is again shown somewhere else. We have the group profit/loss before tax. We have the basic earnings per share, EPS, year-end net cash, and finally we have the non-financial indicators, which according to Superdry, it is just the total retail selling space. Revenue is a key performance indicator. And why is that? Changes in revenue from one year to another can indicate whether a company is growing or contracting, and that in turn can affect company valuation. Superdry suffered a drop in revenue in 2020 compared to 2019 of 167.3 million. This represents a decrease of 19.2%. The role of the financial analysis is to provide an explanation for the decrease. Both external, for example, competition and macro factors, and internal factors such as the wrong strategy adopted by the company and supply chain issues can explain the reduction in revenue in 2020. In fact, in Superdry's case, the financial year end, which ends on 30th of April 2020, straddles the period of lockdown, and hence the shops were shut, and as such explains the lower sales. The published accounts do provide a segmental analysis of revenue to help the reader understand how the revenue has been generated. In Superdry PLC's two main revenue segments are retail and wholesale, and in 2020 the retail and wholesale segment contributed to 62% and 38% respectively to sales. From an accounting perspective, it is important to understand that the revenue includes both cash and credit sales. Likewise, expenses include cash expenses and expenses owing at the end of the accounting period. The expense impairment losses on trade receivables of 9.2 million in 2020 shows that not all credit sales were converted into cash. Cost of sales is a key part of the performance metrics of an entity, but is not a KPI for Superdry PLC. What does it include? It represents the purchase cost of or inventory value of merchandise sold during a stated period plus carriage in and other direct related expenses. A direct cost or expense is a cost that may be identified directly with a product or service. So if the volume / revenue goes up, the direct cost will go up proportionately. The direct cost can be contrasted with indirect cost / expense, such as rent and admin costs, which tend to stay fixed over a time period. The gross profit is a key performance metric for a retailer as it monitors an entity's earning quality and potential. It's the difference between sales and cost of sales. In simple terms, it's the difference between the buying price and the selling price of goods. The gross profit margin can also be expressed as a percentage, and this is more meaningful. It is calculated by dividing the total gross profit by total revenue times 100. So in 2020, Superdry made a gross profit percentage of 60.9%. A simple interpretation of gross profit percentage is as follows. For every pound of sales, Superdry made a gross profit of 60.9 pence. And if we work out 2019, we find that the gross profit percentage was lower at 55.1%. Now, changes in gross profit percentage can be attributed to the following: increase or decrease in selling price, efficiencies or inefficiencies in buying, and finally changes in the exchange rate and supplier's currency. Selling, general and administrative expenses. What does it include? It includes staff cost, premises cost, and depreciation. Depreciation is the annual wear and tear of property, plant, and equipment that is owned by the business. This is essentially an estimate based on various assumptions: the estimated life of the asset, the estimated pattern of usage of the asset over its life, and its residual value. The important thing to remember is that depreciation is a non-cash expense. In accounting, depreciation is defined as the reduction of recorded cost of a long-term asset bought in the past in a systematic manner until the value of the asset becomes zero or negligible. In the case of Superdry PLC, the annual report gives some information about the assumptions made regarding the life of a long-term asset. For example, if you take furniture, fixtures and fittings, the life is between 5 and 10 years on a straight line basis. The word straight line means the amount of depreciation is written off equally over each year. For freehold buildings, the life is 50 years, leasehold improvements between 5 and 10 years, computer equipment between 3 and 5 years. But land is not depreciated. What happens is that the residual values and useful economic lives are reviewed annually and adjusted if appropriate. There are more than one KPI when measuring profit. Operating profit or loss refers to the operating profit or loss before deducting interest and tax, sometimes called PBIT, or in the case of a loss is called LBIT. This KPI provides insight into a company's operating efficiency, that is after deducting the cost of operations such as selling and admin costs. Superdry PLC made operating losses in 2020 of 159.4 million and smaller losses of 72.1 million in 2019. Operating costs, which are usually referred to as period costs, are difficult to change in the short term. Many of them are fixed or semi-fixed costs, as they do not change proportionately with changes in sales volume. This KPI can also be expressed as a percentage. For example, in 2020, the LBIT, which is the loss before interest and tax, is 22.6%. And this KPI is widely used in comparing profit performance with other companies in the same sector. Right, the next profit KPI is the profit or loss before income tax. In 2020, Superdry PLC made a loss of 166.9 million, and this figure is derived after deducting interest costs and impairment losses on financial assets. Interest costs can arise in respect of loans / overdrafts and on lease liabilities. The interest cost of 7.7 million in 2020 relates to interest cost on lease liabilities. The next KPI is the profit or loss for the period, and this is arrived at after deducting interest and tax. It is a KPI as it is the profit that can be distributed as dividends to shareholders. In 2020, the loss for the period is 143.4 million after receiving a tax credit of 23.5 million. Now, many businesses can continue to trade in spite of making losses as they have positive cash balances or are allowed by its bank to incur overdrafts to fund these losses. The profit or loss for the period figure is also used to calculate the earnings per share or EPS, another important KPI. The earnings per share is an important KPI. It shows the annual profit or loss for the period attributable to each ordinary share. It is an important KPI as the market value of a share is often expressed as a multiple of its EPS, where it is making a profit. The weighted average number of shares is used when there has been an issue of ordinary shares during an accounting period. As an example, if there are 100 ordinary shares at the beginning of the year and 10 ordinary shares were issued in the middle of the entity's financial year, then the weighted average number of shares at the end of the year will be 105. The EPS is always expressed in pence. Superdry PLC's basic EPS loss per share in 2020 was 174.9 pence, and in 2019 it was 124.2 pence. IAS 33 also requires listed companies to disclose both the basic and diluted EPS on the face of the income statement. The diluted EPS takes into account potential shares that will be issued in the future. An example of potential shares are share options granted to the management, which will crystallize into ordinary shares in the future. The income statement provides an entity's financial performance over a period. Revenue and profit are the most important KPIs, as it indicates whether a company is growing or contracting. Listed companies are all required to include a 5-year history of its revenue and profit data when publishing its annual report. Where a company like Superdry PLC has made operating losses for 2 consecutive years, there will be questions about its future as a going concern, i.e., will this company continue to exist or be in business in the future? The auditors of Superdry PLC have addressed this concern by confirming that Superdry PLC is a going concern for at least 12 months from the date of the audit report. The directors of Superdry PLC have also confirmed the company's viability in meeting its cash needs over a 4-year period. Now let's go through the key assumptions underlying the income statement. 1. Income statements are prepared on the assumption that the entity is a going concern. The income statement shows the profit or loss and not the cash generated in a period. Superdry PLC operating losses are bigger because of the inclusion of non-cash expenses such as depreciation and impairment of assets and receivables. The balance sheet and cash flow statements provide a better measure of a company's liquidity.